What if I told you there was a way to get a 3% interest rate on a VA loan today? With over 2 decades in the lending business, I'm here to show you exactly how you can do that through a VA loan assumption. This could save you over $1,000 a month on a $400,000 loan. So stay with me here because this might be the most important video you've watched this year. Hey everyone, I'm Jason Wood, better known as the VA loan guy. I've got over 2 decades of mortgage lending experience, ranked as one of the nation's top VA lenders. And today what we're gonna do is we're gonna break down what is a VA loan assumption, how to cover the difference in the gap between the existing loan and the purchase price, and pitfalls you should avoid just to make sure it doesn't cost you hundreds of thousands of dollars. So let's start with the basics on what a VA loan assumption is. So a VA loan assumption is you stepping in and taking over the mortgage that somebody else currently has. So they would sell you the house and they would allow you to communicate with their lender who's sending them their bill every month for you to communicate with them to take over that loan. Now, you do have to qualify for that loan. So you're gonna have to make an application, provide income and asset paperwork so they can vet you out and make sure you qualify for that existing loan. So for example, if you were taking over a $400,000 loan and they had a 3% rate on their VA loan, it would be a payment of roughly $1,680. Today, with nearly 7%, that same loan amount would be almost $1,000 more, about $2,600 a month in your total monthly payment. That's a large gap. And if you could mitigate that gap by taking over someone's loan, that is a huge home run and a super smart way to save some money. But the benefits to the VA loan assumption go beyond just the interest rate. Some of the other really great benefits of doing the VA loan assumption are you have lower costs and fees in doing a VA loan assumption than you would a traditional mortgage loan. So to do the VA loan assumption, the VA does still charge a funding fee, but it's only 0.5%. When you compare that to a first-time use of a VA home loan at 2.15%, that's a significant difference in just the cost. Also, the lenders are capped at a $300 processing fee on the VA loan assumption. And in the open market, you can see those fees double or even triple that amount on a traditional VA loan purchase. One of the other really amazing benefits to the VA loan assumption is it is open to more than just veterans. You do not have to be a veteran to assume a VA loan. Now, there's some things that are important to understand and what's happening behind the scenes during the VA loan assumption process. When you have a VA loan, the VA allocates what's called entitlement, which is a guarantee. So the VA guarantees 25% of the loan to the lender in case of a default. So as a veteran who has a VA loan, my certificate of eligibility will show that I have a 25% entitlement, or to show the dollar amount, which is 25% of my original loan amount that is outstanding on that home. If another veteran is assuming my loan, then we swap entitlement. So now their entitlement is encumbered, mine is restored, and I can go out and use my VA loan again and buy another house. But if we have a non-veteran coming in to assume that VA loan, now the departing veteran's entitlement is still tied up on that house. So for the veteran who's selling the home and wants to go purchase something else, they now have to make sure they have enough entitlement to purchase the next home, or they could be landlocked and prevented from using their VA loan on the next house until this new buyer sells or refinances that loan out of the entitlement that's being used. So let's go into a couple practical examples of how this is going to work. Now we have some gap financing. And so what gap financing is on a VA loan assumption is basically covering some of the difference between where the existing loan is and where the purchase price is. So the benefit of the VA loan assumption is taking over a mortgage with an interest rate back from 2020 or 2021 when mortgage interest rates were at record lows. But the other thing that's happened over time since then is home values have appreciated. So now people are going to be selling their home for market value, which is largely going to have an increase in its value compared to when they did that loan in 2020 or 2021. So the difference between what they owe today and what the market value is a difference that you as the buyer have to cover. And there are a couple ways that you can cover it. You can use your own personal funds to cover it. You can get gift funds. You could be selling another piece of real estate or an asset to make that down payment and cover that difference in gap. But not everybody has that amount of money because oftentimes we're looking at several $100,000 between the existing loan amount and today's current value. So we have a gap financing tool that will allow you to cover most of that difference. And here's how it works. Our gap financing tool is a second mortgage, so it closes concurrently with the VA loan assumption that you're doing on the purchase. So you would apply for the VA loan assumption with the existing mortgage lender. get approved with them. Concurrently, we would be working on your second mortgage, getting you approved for that, and both would be processed at the same time. When it comes for the closing day, both of them close at the exact same time. Your second mortgage is a second mortgage lien on the home you're buying. So you do not have to have another home to get this loan. It's for the one that you're buying, and it is leveraging the equity in that new home. Our program requires that you still come in with some down payment. So it will not cover the entire gap. It will cover most of it though. So when you're using this program, you need to come in with a 10% down payment. So if the home purchase is $500,000, you will need $50,000 as down payment. And then the second mortgage can cover the gap from there to the mortgage balance. The other caveat to this is that the second mortgage has to be a minimum loan amount of at least $50,000. So there are going to be some scenarios where that gap isn't quite big enough for the gap financing to come and plug into place there. So the gap financing, we have two different options for the type of loan that you can use. Now, both are considered second mortgages. So what is a second mortgage? What is a first mortgage? Let me break that down for you. And the reason that there is an actual label or a description on these has to do with foreclosure proceedings. Now, we all pray that none of us are ever in the situation where there's a foreclosure happening. But in that legal process, where a bank were to foreclose on a home, they take ownership of that home, then they auction it off. When that home gets bought off the auction and the bank receives the money for it, they then have to pay the liens based on their priority position. So a first lien is the number one priority. So they get paid first. So like a VA loan, for example, is a first lien position loan product. So in that example, that VA loan will get paid first. A second mortgage or a second lien position loan is something like a fixed second mortgage, a home equity line of credit. Both of those are second mortgages. That gets paid next. So that's why it's termed a second mortgage. And by nature of it getting paid second in that worst case scenario, it takes on a little bit greater risk. So that's why you will see interest rates on second mortgages be higher than interest rates on first mortgages because of their foreclosure lien positioning. So in our gap financing, we have two different options. We can do a home equity line of credit or a fixed second mortgage. The differences between the two are this. The home equity line of credit is exactly that. It's a line of credit. So you're approved for a certain amount of loan, and as you pay that down, you can reuse it again. Conceptually, it works in a similar manner to like a credit card, right? If you had a credit card with a $5,000 limit and you spent $5,000, it's maxed out. You can't spend anymore. But as you pay that credit card down, now you can reuse the credit card because you've opened up some of that line of credit again. A home equity line of credit functions in a similar manner where you have the acquisition of this home. We're going to max out that equity line to purchase the home. But then as you pay it down, you'll have availability to use this again for other opportunities that come your way. So this is my favorite of the two tools because during the loan, it's a 30-year total term, and the first 5 years of this are the draw period, meaning you can pay it down, draw against it, pay it down, draw against it as often as you want. At the end of the first 5 years, it now becomes a fixed mortgage, amortized over a 25-year term. So the grand total of this loan is 30 years. The first 5 is the draw period. The second set, the 25 years, is just fixed. It's the repayment of whatever's existing there. So during that first 5-year period, the monthly mortgage payment that's required is the interest-only payment. So if you make that payment every month, you're only going to be paying the interest. You won't be paying the balance down. So you have to be cognizant of that to make some extra payments to start chipping away at that balance. The interest rates on the home equity lines of credit, they follow and are tied directly to the federal prime rate. Very different from traditional first mortgages, which are not tied to the Fed prime rate. So a home equity line of credit is something that can adjust. Anytime the Fed meets and makes a decision on the Fed rate, whether it's up or down, your home equity line of credit will then adjust accordingly depending on what the Fed's move was. Fortunately, as we enter into 2025, we are in a downward projection for Fed interest rates. So you would be the beneficiary of your interest rate actually reducing over time if everything follows suit. The other option that we have is a fixed second mortgage. And just by the nature of the title of it, it is fixed. So you can choose the term anywhere from a 30-year term at the max and then 5-year increments down from there, down as short as a 10-year term. So your repayment calculation is going to be based on the total length of term. So if you want a lower payment, we want to have a longer repayment term. So we want to have the 30-year term to keep the payment as low as possible. Now, the advantage to this product is the rate is fixed. So if that variable component of the equity line makes you nervous, then this is the product for you, because that interest rate is going to be fixed. It will not move in the entire life of the loan. It will stay there. The downfall is if rates start to come down, your fixed second mortgage will not go down. It's going to stay at that price. And it's a fixed second mortgage. So as you pay it down, you will not be able to draw against it again. You're just repaying the loan. So those are the two different products that we have in order to help you with this gap financing. So let's walk through a practical example so you can see how this works. Let's take the purchase of a $500,000 home. This $500,000 home, it has a first mortgage balance of $400,000. So our total gap is $100,000. The sales price of $500,000 minus the existing loan balance. Now you're going to apply with that seller's lender to take over the $400,000 piece. For the second mortgage, we are now going to put that together after we've calculated your down payment. So for this product, we need a 10% down payment. So 10% on $500,000 is a $50,000 down payment. So now we're left with a $50,000 gap. We can finance that $50,000 gap. And if we did that on the home equity line of credit, interest rates on those are ranging anywhere from the high 7s to the 9% range, depending on credit and qualification. So let's just assume an 8% interest rate on $50,000. That's going to be about $330 per month in your monthly payment, or $333 to be exact. So now you'd have the payment on the loan you're assuming, that really great low rate that's maybe in the 2s or the 3s, and we would add to it this $333 a month payment, and that would be your new total housing payment for this home that you're going to take over. So what are some of the qualification requirements? Like, how do you get this second mortgage? Like, what kind of credit do you need to have? What do these things look like? So for our second mortgage product, you need the funds. You need the 10% down payment. The second thing you need is a minimum middle credit score of a 680 or higher. With home equity lines of credit and second mortgages, they are more sensitive to your credit score than some other loan products out there. So the higher your credit score, the better your lending terms will be in terms of your interest rate. So if you want the lower rate, then you need to make sure that your credit is as high as possible to drive the interest rate even lower. And finally is your debt to income ratio. And yes, the debt to income ratio is still a calculation that we have to do. And the mortgage company you're assuming the loan with will also do a debt to income ratio calculation. They will be talking to us, so they will have information on your second mortgage as well to put in their calculations. For the second mortgage, the debt to income ratio limit is 43%. So we will work up that calculation for you to make sure that everything fits so that you can successfully go out and make an offer on a home for a VA loan assumption. Let's talk about the pitfalls of the VA loan assumption, because there are some. Number one, you cannot get another VA loan to pair with the VA loan you're taking over. So there's only one VA loan at a time on a property allowed. So you're just going to be assuming the existing VA loan. So if you don't have the credit score or the means for the down payment or to cover the entire gap out of your pocket, then the VA loan assumption process is not going to work out for you. But where this could really cost you money is not properly vetting and understanding the timeline process for doing the assumption. So the assumption process varies between every lender. Some lenders are closing these at a reasonable pace, which is 30 to 45 days. And there are some lenders out there who are still taking 6 to 12 months to process these assumptions. The hope is you don't end up with a lender that is taking a super long time, but we won't know that until you've made contact with that lender and understand how long it's taking them. So what's the why? Why does this take so long? What's the big deal? Well, the thing that most people don't understand is the mortgage company that sends the bill every single month to collect your payment is a mortgage servicer. Now, they're still part of the mortgage industry, but they are typically not structured in such a way to start new loan applications. Their staff members include people who have mortgage experience, but oftentimes are people that are just answering the phones and providing questions to statements, payments, impound accounts, insurance, property taxes, and documentation. So they're not staffed adequately to originate or start new mortgages. So as mortgage interest rates began to climb in 2022 and the VA loan assumption tool became more and more popular, the demand became higher, and all of these mortgage servicers found that they are understaffed to perform the VA loan assumptions for the amount that they were being requested to do. So they're oftentimes reaching into their office for people that used to originate loans many, many years ago and throwing them to the wolves and saying, here you go, figure it out. Here's 200 files to get processing. Well, you can imagine for somebody who hasn't done that in a decade or more, that's an arduous task on top of a huge workload to begin with. So they're not adequately staffed to move through these things in a quick manner. And that's why they can be taking a long time to get through. So understanding what the timeline is going to be part of the due diligence you do when you make your offer with that seller and get their permission to talk to their current mortgage company. You need to find out what that turn time is going to be for them to process your loan assumption. Because here's the other thing that a lot of people forget to think about when they're trying to purchase a home and assume that really awesome interest rate loan. What they forget to account for is, what is the seller's decision? What buyer are they going to select to purchase the home from them? As a seller who may have a time crunch and needs to be out of that house by a certain period of time, a VA loan assumption may not be attractive to them. Even though technically their loan is assumable, they may say no to your offer because you want to assume the loan, and they have heard or they already know that the time to process that assumption is going to be greater than the amount of time they have to get sold and move out of that house. So it's something to be very aware of as you're trying to make offers on loan assumptions, is that the seller may say no and take another buyer's offer who's using traditional financing and can close in a quicker period of time. To avoid that pitfall, one thing that my team and I do for all of our clients pursuing a VA loan assumption is when we build their file for their home equity line of credit or their fixed second, the other thing we also do is build a separate file for a brand new first mortgage for them as a fallback plan, as a plan B. What you don't want to do is fall in love with your dream home and it has a great low interest rate. You're going to assume it. We've got the financing lined up. You've got your down payment, only to find out the seller doesn't want to cooperate and they don't want to let you assume it. And they have that power and that ability to say no. So now what do? Do you walk away with your tail between your legs? If this is a house you're totally in love with and you've envisioned your family and having memories there and everything else, and this is the dream home, probably you don't want to walk away from this house. So you need to be able to pivot and have a strong plan B to come in and still acquire that home. So that's why we put this plan B together for you so that you can still jump in and save that house. So today we covered the basics of the VA loan assumption, the benefits to doing a VA loan assumption, and the pitfalls that can happen during a VA loan assumption. So if you're serious about saving money on your home purchase in 2025, here's what I want you to do next. Download my free VA loan assumption checklist below and book a free consultation with me and my team on the link provided down below. Subscribe and hit the notification bell so you can continue to stay up to date on everything new with the VA loan. This is Jason Wood, the VA loan guy, helping you navigate the VA loan process like a pro. Remember, whether you're a veteran or a civilian, the VA loan assumption could be your ticket to huge savings on your monthly payment. Stay tuned for more VA loan information, and I'll see you on the next video.